Welcome back to Be Great Economics. This is Nate. This is your weekly update. It is Tuesday, the 15th of March, and we're going to start covering our stock analysis throughout the following week. As I discussed before, we are still in a bearish trend. We broke down from this liquidity plunge here after a distribution event, and so I would anticipate a little further downside, which we've maintained down here. However, I am going to present again a bullish thesis as well as the bearish thesis and the kind of gives and takes. So some of the problem with trading or traders in general and technical analysis is that most people see it as predictive, but it's not. It's meant to be a hedge. It's meant to give you an edge in the market's response. And so you need an if this then type statement in order to make a plausible response, and that just gives you the probability that you are more likely right than wrong. It doesn't necessarily mean that that is predictive of all activity, but that trends tend to repeat themselves throughout markets. And so what we're going to do is make some reasonable assertions on probability throughout this episode. So what I want to bring up here is this long descending down line. If we can't break this, this is the if statement. If we cannot break this, then we can't go up, period. Now you can go through this sideways and then you have the potential for more momentum. Now, yeah, it's like, oh, if it goes up, then that means it's going up. Well, yeah, these trend lines are responsive to human psychology. That also doesn't mean we go back to the top. It just means that we have an opportunity for a liquidity grab up high, right? People to get back out. It's called a bear trap or a bull trap technically, where you're going down, you get a plunge up and people go, oh, it's recovering, and then it doesn't. But it also allows the people who are down here to get back out. So where's the fundamentals for some of this? Obviously, the Fed is tightening. We know that. We know that the taper of bond purchases has occurred. We're down to 20 billion in the past month's purchases instead of the 110 average. So we know that they have purchased less. We've seen that the bond yields have gone skyrocketing. So we can anticipate the liquidity tightening to continue from here. And since real rates are already up, the Fed has basically been given free rein to have prepped the market so that this way the market will price in those hikes before the hikes even happen. So if they raise rates 0.25 or even 0.5 basis points, I think that you'll get a temporary move in the market only to recover right back to where it was. Now, since the market has priced this in as extreme bearishness, there is a probability that we begin to move up, because historically when the federal funds rate begins to climb, at first, at the very base of it is a shakeout and then a final blow off top, and then that signals the end of the bull market because the rates eventually kill the ability for the market to go any further and max euphoria kicks off. Now we still need catalysts. It shouldn't just go for no reason, so we should expect either they're going to say they're not going to taper as aggressively, or conflict could end. Something along those lines could give us a bullish reason to move, but we do need some type of catalyst to run on. But once that catalyst is there, it will start moving. We do have the momentum ability, because you can see we are maxed out pretty far down here on the MACD, our moving average. You can see that we're kind of dying off in the total velocity or volatility of this action, so we should be able to see that we have the ability to see some upside. We also have bullish a bullish divergence here in the RSI ascending while the price is descending. So we should see some type of liquidity grab up. Now, I would expect this resistance to stay in the S&P 500 for a while. And that should mean that if we're going to come up, we'll probably come up and test it and then bounce off of it. Whether we come here and consolidate and then move higher, or we come here and stop. So I would watch this area, and then your stop losses, if you have any, for any type of play in here, say you bought down here, would be the bottom trend here, right? The limiting line. So let's look at the Nasdaq, right? Our risk trade, our max risk trade kind of opportunity. We saw the distribution event. What I would argue here is we are forming, and I brought this up on Twitter, a possible accumulative event. But in order to be a Wyckoff accumulation, which first off, you have to have had a distribution. We had that. Second, we have to break above this descending line. We haven't really been able to do that. We broke the small one here, but we haven't reset. I would say this is the plunge for liquidity test. This would be your max selling. This would be a secondary test. This would be a automatic retest that sets the top bar. Oh, look, that was our point and figure target down here, which was this liquidity plunge. And then this plunge, which happened to also be our point and figure target, is right here. So these are very responsive to these lines right now. The market is pricing in activity based off of prior trends. So I would expect that we should see some type of rally. Now it could be up into any of these resistance here, this line here, we'll put that one in just so for memory's sake. This line here, and then pretty much anywhere where you've seen like max consolidation before or a point of resistance before, this whole bottom line here, this area is going to give us trouble. And so if we don't have that bullish catalyst, I would say, if statements again. If we break below, all right, we're going further, right? If we break a little below at all, we'll probably go into the next zone. I would say that the next zone, I think I had a point figure target down here, but I didn't mark it on here, but it should be around this range at around 11.5, right? So, because there is a prior plunge way back here, 10,000, yeah, so it's this range, the 10,000 range, right? Now that's pretty scary because that would really be an end of bull market type move. We're already down 23% on our max, 22% on our max downside, so 21. So this would normally be referred to as a bear market, but we could hit max bearishness here. We're seeing that the market response here is pretty negative, and so I would anticipate that there is a probability of a rally. The thing that would stop us from going any higher above this line, or this line, ultimately, is that if there's not a bullish catalyst. So we could do this move without a bullish catalyst. It could be a nice slow lumbering move up here. You could see it kind of weave up and then die. But one way or another, we're probably going to get some type of move up here. I think that that's a higher probability than just falling from here because we've already sold off a lot and there are a lot of people starting to talk about buying in here. So that should send us up a little bit and at least use it as a liquidity grab for previous bulls to now become bearish. If we get some type of catalyst, then we could move further. Again, end of conflict or something like that. Let's look at the Nasdaq Sp 500. And I brought this one up on Twitter and my Facebook, but you can see that as I brought up a couple weeks ago, we broke down, we retest, and we resumed back down below this ascending line. So I've turned this one into a broken line, a dashed line. We do have this trend line intact at this point, but it is barely intact. We are holding by a thread. I would say that this could move in a positive fashion overall, but we would really want to see it hold and resume, and we want to get back above this line. So that would, again, I need a bullish catalyst. I need some type of event that's going to make people think that the blow off top, the melt up can happen. And if not think a melt up can happen, markets will recover, which would be even better because if they don't think that it's going to blow off top, then they're just going to rally into it and think that stocks only go up. This will probably include Fed easing, but it would require a narrative shift in both directions to think that inflation is only by other global aspects than money supply, so that which apparently, according to some polls, 83% of Americans think that it has to do with Russia and COVID, which is hilarious. I like the gaslighting, but it is what it is. So let's go to gold real quick. We're going to take a look into gold right now. As I brought it up on Twitter. I think I brought it up last time. It was 1916 was approximately the place I was targeting, and we touched it. Like we actually came a little below. Oh, look at that. But we came into here, and I said that this was our estimating range of support. I will put a line in. I should have brought this up more clearly. I should always remember to put in lines when I say these things. But you can go back test my statements. I think that we're going to see some consolidation here. We could have come up and then go through a little bit of a sideways action. What I would expect is that if they continue to taper, let's say they start quantitative tightening where they start selling bonds in the market, we could see gold not necessarily run very hard. But if they continue to tighten at the rate they have said so, the market has already begun to price this in, and they're expecting it to lead to some type of recession. As I brought up last time, the bond yields are starting to invert, and so the market is going to get scared, and this fear trade will take off. If they begin to loosen, the euphoria trade will alternatively, or the counter trade will be, inflation's going to continue, and so you should probably buy some gold. And so the market will price that in. You also have global conflict fears. If that is taken away from you, then that is a probability that we go up less high. However, regardless of what the Fed does, unless it is an extreme amount of rate hiking that leads us into a really fast depression, which I don't think will happen, if we get 0.5 or less tomorrow, then what I would anticipate is that this is going to continue to rally. because it's already priced into rally. This action has been building for months, and I've been talking about it for months. So let's go to silver. This one is on my, I will do a short video on my 1,000 to a million trade right now. Let's do XAG because that's when I have all the good stuff on. This is my 1,000 to a million trade where I'm doing SLV. Don't buy and hold SLV. I use it for options and then I get rid of it and swap it to cash or something else. But I do options on SLV and I'm doing them right now for 24.50 strike of June 30th this year. And I'm hoping to hit the target sometime before the end of April. And if I can achieve that, if we hit $30 silver, we should hit easily 26 or above SLV, and that should give me 100% plus returns. So that is the next trade. I'll show you what I gave up here, and I told you this is the Wyckoff accumulation. We're going through our breakout, sign of strength, right? I'll take this up here. Sign of strength, our LPS, all right, our lines of support, our purchasing areas, buy ups, and then we're going to go up here. So I would expect mid-April to be moving really hard here. So it could happen faster. I've seen a lot of this happen faster, but I'll give it a little bit of time. At least this one touch has to come up and we have to resume back above this sign of strength. So let's go to copper. We'll review. I still am bullish on copper, right? And I've said this is that it's looking good. We're still in an uptrend, but what I'm expecting is silver to outperform copper. The reason why is because of all the accumulation zone that I've built and everything. While copper gives me a little more time to it, I think that silver will be a better play. I think it's a better value, and I've honestly just been wanting to play the silver game, so I would like to go in as hard as I can on it because copper has a good correlation to gold, but I'm wondering if that $6 point can really be hit in any time soon. So I didn't get to take as much profit as I wanted. I sold a little bit here, but I sold most of it down here because I said, all right, I'm near my stop loss. I'm going to take it now. And so I'm at like a 15% total profit. So it was time to just leave it and let's move on to the better play. I think silver's a stronger play here because I think I have a better beat on that one, but I'm still bullish on the copper right now. Now let's look at platinum US ounces, right? This one, we're coming back in for a retest. Don't be surprised if it doesn't come in all the way down here and retest 900. This could happen simply because this has been the main trend line. Now it'd be really bullish to come down here, plunge into here and move up. But let's look at platinum divided by palladium. I saw someone share this one and I liked it because they said it was a big bearish flag building. And I don't think so. And I'm going to show you why I don't think so. Now you can see palladium really ran up here for a minute, or platinum outran palladium for a minute on a liquidity plunge. But what I think is happening here is an accumulation zone. This is your selling climax secondary test that, like these Wyckoff accumulations tend to happen in groups throughout events because markets start to move in the same patterns together. And so you're going to see things of like and counter plays like Nasdaq tech versus commodities. You're going to see responses operate in a more distributed than a cumulative pattern. And so I wouldn't necessarily call this a bear flag just yet. The way the person depicted it was like this, saying that this was a bear flag on platinum and palladium would be going down. Now, I'm not going to say that platinum or any particular reason why platinum or palladium is going to outperform one or the other. I would rather say that they tend to trade inside of a range and we are down below that historic range. Let me go to the monthly here. Right. I'm sorry I only have been doing commodities lately, but it's been the big focus and I want to stay on target for things that matter. We have this big trading range here and we are way below it. So palladium is way overvalued to platinum and yet they're used at about the same rate, consumed for pretty much alternate similar things, catalytic converters. It just depends on whether or not you're preferring it for diesel or gas, but the price will also determine whether or not you're going to use one or the other. And so if the price is this low on platinum, you're going to start switching over to platinum. You even use more platinum when you're using 3 or 4 times the amount of platinum for a quarter of the cost. You're going to be willing to use like twice as much because it'll still save you half the money. So they're going to be willing to do more with it, and that will resume its trend. And so I would say that this is still a value play versus palladium. But overall, Russia and Ukraine are big producers. Russia specifically is like I think the #1 producer, or at least location to mine platinum and palladium. The #1 miner for revenue of platinum and palladium is Sibiane Stillwater in Africa and Montana. I know that because I really reviewed their stuff and I really like it. But platinum is probably going to keep up with palladium a little more than people think. But either way, I would just buy a mixed bag of it if you were going to play that one. Let's go to Bitcoin. All right, actually, let me go to my Coinbase one here because I have that chart already built up. Now let's look at the 10-year first. As you see, we're on an uptrend. We're jumping up. I saw Jordan Lindsay point out that we are in a breakout retest resumption trend here with a very strong rebound away, and if the Fed has stopped their purchases, then we should continue yields to rise, and part of yields rising means that they are going to push capital into alternative investments, right? At the same time, the dollar's been strong, but if yields start rising like that, the dollar could weaken a little if it doesn't keep up some strength along the way. Or if the 10-year bleeds really fast, that could be an urgency to get away from dollars, and so it could calm down. From here, what I would note is that the British pound and the Australian dollar are both all the way down at supports against the US dollar. And so a concern here is that if they fall below it, they could send us into much more deflationary response than we're willing to accept, and so then we could try to hurt the dollar ourselves. If the line doesn't give, then we should still see the dollar start to fall anyways, because there's going to be a response trend to reverse that action, because the European dollars, or the British pound, the Australian dollar, the euro, that one too, are all at a support line and should be rebounding from here. So we should see the dollar finally start to calm down a little bit. Oil. Jumping around a lot. Sorry, I didn't have my notes ready, but we're broken out. We're retesting. This is the zone I said. I said about $109 would be where we retest. We came a lot lower. I'm glad. I will save a few bucks on my gas in the coming days. But I don't anticipate this to stay down. I wouldn't necessarily say that it should run to 120 again anytime soon. You probably see some more consolidation. Maybe we stay above this trend line and then resume on a soft trend up. Overall, in the longer term, the next couple of years, I would anticipate that that oil is going to continue to run higher. If we don't see an end to some of this conflict issue, we are going to continue to see oil prices rocket. Not only that, but if more militaries in the world get involved, the consumption of oil has to increase in order to accommodate that productivity and that warfighting capability and that destruction. So I would just watch oil. I would hedge yourself against the risk of inflation with oil wherever you can, but you can also do it with other commodity assets. We'll go to uranium real fast. I like to end with Bitcoin because it's such a popular topic. If we go to uranium, we can see that we're still on this ascending trend. However, today we broke down below, came back up and retested. And so this might be the point to watch. I think I brought this up as that on Twitter, is that we might see this break below. So what I would watch out for is that this might be resuming back down. Overall, we could see a consolidation. This could be an L8 wave, 1, 2, 3, 4, 5. So we should see an A, B, C correction and then continue back up. But uranium can also surprise you and become very explosive. So sorry for not being straight on these notes, but it seems like we're more likely to go down for a little bit in a corrective wave than we are to go up, if that makes it more clear. If we break back above this line or we continue in an uptrend, then I would anticipate, if this is an A and a B, and we can break above the line or we can break above the top, then we'll continue in an uptrend. So I'm not bullish here. You could buy here, but the corrective wave might give you an opportunity to lower, so maybe do it in tranches. If you're expecting an ABC wave, then I would buy the A and the C. Okay. All right, now we'll do Bitcoin, right? Oh yeah, I said I was going to do my Coinbase one. I gotta stop drinking coffee this late at night, right? So, but let's do Bitcoin. Yeah, it took me a while. All right, Bitcoin, look, we're still going sideways here. We are coming kind of into this little bit of a taper trend. Volume is descending again. I don't see the bullish price thesis right now. Fundamentally, I like it. In terms of supply and demand function, I like it. But the volume as a trade is not supporting anything right now. It's nice to see that we're tapping above 40K, but we seem to be struggling with it. What I would expect is that, take off log, what I would expect is that we should come back down. If we see anything like this is truly a bear market run, if we're going to see a crash in the stock market, if we're not going to see a melt up, if we're going to see deflation, then this definitely should liquidity plunge down to like 29K or so, right? Like we should see a capitulation, just one, blah, screw you, screw everybody participating, 30% off, right? That would be where somewhere below, say below this wick at 33, would be where I'd be max bullish, because at this point, the discount rate is so high that statistically, I'm just likely to make money over the next year. So at 57% off, most people have not lost money in any period longer than a year. So I would not, anytime it's below 50% loss, right? So if we can make it down there, great. If not, okay, cool. What I would say is you should be accumulating dips still, but I wouldn't use leverage. This wouldn't be my main play right now. This was my main play back here when we had this accumulation zone. It was my main play back here when we broke down and held support after a triangle breakout. So I was pretty much all in right around here. I would not say that this is necessarily an all-in zone, nor do I have enough confidence in it because the market structure and the macro environment fed this. And it doesn't feed this as much. Doesn't mean that the melt up could send us sky high. And so this could be a good play if you're betting on tech because we do still have both the tech correlation and the monetary correlation. But what I would say is if you're betting on the tech melt up, then maybe Ethereum is going to do better. For the sec on log. You can see that we broke out of this shorter term downtrend, but then let's reinstall this one here. And you can see that we're still in a downtrend. We're still really not breaking out. If this is some form of accumulation, it's a weak one. And so I don't have the confidence yet. I'm not saying that it's bad, but we aren't seeing the type of positive volume response that we should. And so there's no confirmation. So it's not a good trade, nor is it a great long-term entry just yet. Now, again, how many people have lost having bought Ethereum 40% from the top? Not very many. What about if you bought it from 55% of the top? Not very many have lost money at any point in its lifespan. That doesn't mean that it could end a bubble in Ethereum or Bitcoin. They could be replaced alternatively. I have a very bullish thesis on Bitcoin. I have less of a bullish thesis on Ethereum long term, but I still buy and hold some of it. So what I would expect is that this is going to play out longer term. This could still be a good buy, but I don't have a positive trend here, and so I wouldn't focus on it just yet. When we get an opportunity, you might lose a few percentage here, but when you're looking at hundreds of percents return, losing out a couple of percent, picking up pennies in front of a steamroller versus giving up pennies to win dollars. You gotta pick your battles, and so I just don't see this as a worthy battle right now. So thanks for watching. I will see you all next time.